Okay, so hi guys, welcome back. So I'm thinking of doing a four-part series where I look at the four main big banks of America, Citigroup, Wells Fargo, Bank of America, and um, JP Morgan. So this is the first one, and I'll be looking at the Bank of America. The current stock price. The current stock price as of me making this is $29.19. Also, if you're not subscribed and you enjoy this regular content, please consider subscribing. Okay, so on to the video. So what does the future hold for Bank of America? Because we all know it's a well-established company, so where will it go in the future? So the first question I want to ask is how well is this company prepared for its losses? Because we know it's been hit quite hard by the coronavirus pandemic. So in quarter three of 2020, the company itself had set aside $19.6 billion, which is twice as much as the loan loss they were expecting. So they're expecting close to $10 billion of loss based on loans not being repaid. And they saved $19.6 billion in case of this. And $19.6 billion is 2% of their loan account, and so far the losses during 2020 have only led to 0.4% of their total loans. So they still have a lot of cash in the bank, not in the bank because they're the bank, but they have a lot of cash set aside for any financial issues they might face, and they are ready for that. And I believe that the bank has already been hit where it is the hardest, because as soon as the coronavirus pandemic uh started going really high in the United States, they stopped giving out loans as frequently and as easily to the greater population, which means most of the loans that they are giving out right now have a higher chance of being paid back. So the losses that they would have sustained were mostly from the loan starting from 2019 or previously, where the customers were unable to pay their loans back due to the pandemic. So I believe the bank has already been hit as much as it would be, and the worst is actually behind us. So how bad can it get? So let's say the loans that they have are even more than they expected. So the Federal Reserve has put all four of the US banks through a series of terrible economic scenarios, where unemployment rate reaches close to 10%, and where the economy starts to go into a recession. So the worst case scenario that they found for Bank of America was that there would be a $47 billion loss. And this is including the $19.6 billion in reserves. So basically they would have a $28 billion loss because they already have 20 billion in the saved. So although the $28 billion seems like a lot of loss, the CFO of Bank of America has also mentioned that they have a $35 billion reserve cushion that they can muster should there be increased losses that they would face. And this $35 billion is including the 19 billion that they already have. So in reality, they have $44 billion saved up, or $44 billion that they can save up almost on the spot should they face any problems in their financial standing. So what about the price? Because we know this stock price has been hit quite hard. It was down close to 25%, 30% quite regularly from its January highs. So would you say that this current price is a time where you want to be buying this stock? So I have calculated kind of like an entry price to where to see. So over the last 7 years, the earnings per share of Bank of America has been compounding 13.6% year on year. So by putting this 13.6%, should they stay at their current level, the earnings per share in 5 years' time would be expected to be $4.61, the earnings per share. So you get a cut, and the current PE ratio is close to 15 or 16. And if you multiply the earnings per share by the PE ratio, because it's a price to earnings ratio, you get a future price in 5 years time of $66.71. So while there's a savings rate of 2.2%, but the S&P 500 usually has a year-on-year growth of close to 10%. So should that be the case, we want a greater than 10% year-on-year return. So if you want a 15% compounding year-on-year return on investment, which is 33% more than the S&P 500 would give you, then you get an entry price of $33.17. And as I mentioned at the start of the video, the current stock price is only $29. So we can see, should the company stay at its current valuation, um, uh, the current price seems like a good time to get into the market. Also, uh, just beware because of, as what I said of the future, the bank is suffering quite heavily because of COVID. So although they have the money to say like basically safeguard their losses, that doesn't mean that their main business will actually not get hit. So there is a chance that the business itself might suffer even though they won't suffer any losses. So just keep that in mind. So now that we see the price is good and the future looks decently good for this company, what about the financials? So are they standing well where they are right now? So the earnings per share currently in the trailing 12 months is $2.02. Last year it was 2.75, and that was because it was hit by the COVID-19 pandemic, and that's why the earnings per share dropped, because they were loaning out less money, therefore making less money back in terms of interest. But the earnings per share was, as I mentioned, consistently growing at 13% compounding year on year. And their dividend, they have a 3% dividend yield and a 35% payout ratio. So this doesn't mean that, this doesn't put them in the top 50% of, top 25% of dividend payers, but that doesn't put them in the bottom 25. So it has a healthy, but not the highest dividend itself. Its free cash flow, it's 42,500 million. As I mentioned, this ties in back to the 19 billion that they saved plus the 35 billion that they can muster. That puts them close to the $44 billion mark, and we can see this line up straight with their free cash flow as well. So the return on equity of 7.35% is actually quite low. You usually want it to be close to 15. However, it has been over 10 since around 2017, 2018, 2019. So I'm willing to give it an exception because it was hit by the COVID crisis. However, the return on equity of the business itself is not particularly high, mainly because of the sector that it's in, which is the banking sector, and because of that, it's not really the most money generating, because it does loan out the money, because it loans out and the interest rates are usually quite low, especially in the US market. The money it makes back, although it's a lot of money, it's because they're loading a lot out. So the return on equity isn't necessarily high, but it is quite stable. So I still think that it's a positive thing. Its net margin of 28.5 is actually quite healthy because that basically means the money that they're spending, like their revenue to profit is quite high. They're keeping around 30% of their revenue as profit, which is that basically means they're not spending too much money in terms of what they are in terms of like maintaining costs. So because it's a bank, it doesn't have too high maintaining costs other than like salary, etc. Its debt to equity of 1.04. So usually for companies, we want a debt to equity of below 1, preferably close to 0.5. But because it's a bank and most of its money or like profit tends to be stored as debt because of the industry it's in, 1.04 is actually a very healthy, especially for the bank of its size. So although the debt to equity, you want it to be close to 1, below 1 or 0.5, you can make an exception for a bank, and that's what I've done in this case. So the financials continued. So the PE ratio of this company is 14.4, which is much below the US market of close to 20. So that basically means you can make your money back on this investment in 15 years. And that is, that basically means its valuation is much cheaper than what the US market is trading at as a whole. The earnings forecasted for this company is growing at 13.28% year on year. So this isn't great, like as I mentioned, this isn't a growth stock. So the earnings aren't growing crazy like 30, 40, 50, 60% year on year. However, 13.28% is very healthy for a company of this size, especially since like it's like a blue chip stock. It has a dividend of 2.5%, and although it is small, it is very reliable, as I'll mention later. And it has a PB ratio of 1. So basically, the intrinsic value of the stock currently lines up with the actual price of the stock, which is twice as much as the US market. So this essentially means that the valuation of the company is twice as cheap as the market as a whole. So the money in the company divided by the number of stocks, you get a book value per share of $29, and the stock price is currently $29 as well. So, although this company will not grow as fast as the market, it will grow in line with the banking industry as a whole, and it is more stable than the market. So, it might not grow as fast as companies such as Apple or Microsoft, Amazon, but is much more stable and a safer bet than those companies, while still not sacrificing the good PE ratio or the good PB ratio should you be investing in an ETF like the S&P 500. So the earnings are up 11% year on year for the last 5 years. However, this year the earnings were negative, not negative. The earnings were reduced 30% from what it was last year, once again because of the COVID crisis. So this company, with it being a large bank, has a perfect balance sheet. So it has an asset level. You can just read it on the side. Just pause the video and you can go through that screenshot I have there. And it has a strong but healthy dividend yield. And over the last 6 months, it has 85 million shares bought in insider trading. So people inside the company have a positive outlook for the future of the stock. So the overall evaluation of this company, I believe that this is a very strong and healthy stock. We know it's a very large and powerful company as a whole, and because it has sunk a lot during the time and it was hit hard by COVID, it has kind of come down to the book value per share, which is a pretty good entry price, especially for the valuation and size of this company. And although they've been hit very hard, I believe that they have the resources to bounce back. And as I mentioned, they have already stockpiled cash, which puts them in a better position than many other growth companies, which have sustained heavy losses during this COVID time period. So, moreover, it's withstood and surpassed the hit it received in the 2008 global financial crisis and was in something economic-wise similar to what it was then. So looking back at its previous track record, we can see that it managed to perform well after it got hit, and it looks like it will do the same now. And especially with the stock trading at its current book value per share, it seems like a great time to buy the stock, especially at its base value. And this has happened because its price was hit. And because of this, I believe that the worst is all behind us. As I mentioned, they have now reduced who they're giving their loans to. And although this reduces their revenue, it also decreases their chance of sustaining losses. So anyway, if you've made it this far, thank you for watching, and I'll see you guys in the next one. Thank you.